Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Once again, I want to welcome you to a subscriber request Tuesday. And I've got kind of an interesting one today because I'm going to cover one of the largest companies on the planet and one of the most widely recognized names as well, and that would be Alphabet, a.k.a. Google. One of the things I want to point out is I'm a value investor, and when I do value investing videos, I always focus on the idea of earnings yield, companies that have earnings yields of 6.5% to 7% or better, and that typically translates into a PE ratio of 15, where, the range is probably something closer to 14 to 16. Those are valuation references that are pretty normal for most companies. But when you're dealing with companies like Google, I think it's important to recognize that you're dealing with a growth stock, a very powerful growth stock. And you actually evaluate those differently. And it all has to do with the power of compounding. Fast growth stocks generate such future revenues, such a mountain of future revenues, that their value needs to be looked at and calculated differently. You don't necessarily use current earnings yield, for example. You're really looking at future cash flows and the magnitude of those future cash flows. And that should become the reference that you're focused on as a growth stock parlay. They call it GARP, as many of you know, is growth at a reasonable price. That's essentially a value growth stock, if you will, a stock that's a company that's growing very fast that you can buy at a reasonable price. Because one thing I don't want you to ever forget about value investing is that the whole idea is to position yourself as an owner of the business where you are buying it at a valuation level that allows you to participate fully in the performance that the business generates on your behalf as a stakeholder. And that's primarily measured by things like earnings and cash flows. And if it's a dividend paying stock, dividends. But of course, very typically, growth stocks, most growth stocks, or many growth stocks at least, won't pay a dividend, which is the case of Google. All right, now, I've also been talking quite a bit here recently about how we're working at FastGraphs to come up with a methodology of valuing a business so that you as investors can go through a process to determine whether or not a stock is real research worthy or not. So let me go into the metrics that we like to look at. There are 16 of them, and it's a process. I think I want to make that clear. It's not so much that any or either of these metrics are important, but let's go ahead and look at them. We're going to start out, we're going to go to the basic fast graph, and I'm going to do that with Google here in a moment for you. We're going to look at earnings growth first. We always start with operating earnings growth. It's just a very good metric that kind of gives you a good perspective of how's business. It really kind of answers the question, how's business been? Has it been a good business? Has it been a steady business? Has it been a growing business, etc.? And then we're going to go from earnings, we're going to go into valuation. We're going to run this through several valuation, earnings, and cash flow metrics. We're going to look at operating earnings. We're going to look at diluted earnings. Diluted earnings are kind of maybe a worst case earnings because they're earnings that would be, available if the company basically diluted, all the options and everything were exercised. So that would be kind of your low case earnings, if you will. And it's also known as GAAP earnings. And then we're also going to look at cash flows, specifically free cash flow and operating cash flow, which give very strong indications of the company's financial stability. There isn't going to be any dividend growth in today's video, but we would look at a consistent growth of dividends if the company paid one. And then we're going to try to, look for some reasonable return expectations. In other words, we're going to do some forecasting. We're going to try to create some reasonable expectations of what the business might do. And then based on what we have to pay for it today, what type of return that might actually present or represent to us. Of course, we want to see a high quality company. So we're going to look at it at the investment grade credit rating as a minimum of BBB- or better. We will occasionally go lower than this, but generally speaking, I'm looking for investment grade companies. And then, of course, if the company pays a dividend, I want to see free cash flow covering the dividend. But I also want to see cash from operations growth and free cash flow growth for that matter. Once I've done that and I'm kind of satisfied that the stock looks worthy of going deeper into the research process, then I will go into the next step, which is still preliminary in the due diligence, and look at financial show underlying numbers, as we call it, or fun graphs. So, researching stocks with fast graphs should be both fast and fun. It's fun because we take all the drudgery out of this process. And so we're going to look at things like cash flow from operations being higher than net income. That's a good indication that the company is utilizing its cash correctly or properly or efficiently, maybe is a better way of saying it. We want to see sales growth. Obviously, ultimately, the bottom line starts with the top line. So we want to see good, sales growth. We want to see net income growth as well. And we also want to see a company that's not overly burdened with debt. A debt to equity ratio of 1-to-1 would be kind of our favorite, but anything better than that would obviously be good as well. Then we want to see good gross margins, but even more importantly, net margins. We want to see gross margins obviously higher than net margins. We're looking at asset turnover. That can be more relevant with some industries than others, but we want to see, assets higher than sales, basically, and how many times our sales are turning over those assets. We're going to look at returns on assets. We'd like to see greater than 10% or better, and returns on equity of 15% or better. And then operating earnings margin, or EBIT divided by sales, is a critical measurement that we would look at as well. So we're going to take this process here, and we're going to put it and look at it and apply it to Alphabet, a.k.a. Google, better known by most of us as Google. And of course, the stock symbol is still Google L. And what we're going to do here, we're going to start with, as I said, with adjusted operating earnings. And I want to make a point. I've got price and earnings on this graph, so I'm going to take price off of the graph here and anything related to price like the normal PE. And the point here I want you to see is that how powerful this business is. This is the profit growth of Google going all the way back to 2004. And you can see it's been extraordinary, averaging over 37.88% per annum. So we've got, very powerful earnings growth. All right. Now, I'm going to put price on the graph to make the point that in the long run, the company's stock price will kind of go where the company's earnings go. So this orange line on the graph, before I leave it, this would represent intrinsic value using a PE ratio equal to the company's growth rate of 37.88. That's very, very important to understand how we value growth stocks with fast graphs. We don't use the typical formulas like the Ben Graham formula or the Graham-Dodd formula, et cetera. We use Peter Lynch's price earnings ratio equal to growth rate. Now, we also give you a normal PE, or what I like to call a market PE, which simply is a trimmed average of what valuation the market has applied. Now, Google's grown at 37.88% per annum over this time frame, but you notice the price or the valuation has often been much lower than that historically. Now, there's a reason for that. As I kind of chop years off, I want you to note that the earnings growth rate can change. So I'll chop 19 and now I'm down to 31% growth. And I'm getting closer to a normal PE here, or a market PE average of about 31. This is an analytical tool. I'm going to go through the 15-year time frame here, and I'm going to see that my growth has dropped to 18.64%. And this gives me a different perspective of what Google's, valuation looks like, at least relative to more normal or, more recent growth. And then I'm going to drop it down to the 10 years, and I'm staying within that 18 to 20% growth rate, we'll call it, okay? Now, I also want you to note here, and I'm going to go back to the long-term graph here. I want you to note that the company has had an enormous, or it's expected to have over an 85% earnings growth rate for this fiscal year. All right, so now this is basically moving into valuation, but I'm not going to look at valuation just from earnings. I'm going to look at it from adjusted operating earnings. I'm also going to look at it from diluted or GAAP earnings, because here I'm looking at, any type of non-related charges, accelerated depreciation, et cetera, all of the GAAP convention stuff here. And I get a very similar picture with a very similar historical growth rate, okay? So diluted and GAAP earnings give me pretty much the same view of Google. I'm going to look at operating cash flow. Once again, I've got 31%, almost 32% operating cash flow growth, and I've got Google or Alphabet trading at about 21 times operating cash flow historically. That's important. I'm going to go in and look at free cash flow and free cash flow growth, and you'll see that free cash flow is growing about 24%. But once again, I get a nice correlation between price and cash flow. The company normally trades at a much higher price to cash flow than its growth rate. That's just, again, the nature of the beast as I'm looking at it. I'm then going to look at other cash flow oriented metrics like EBITDA, earnings before interest, taxes, depreciation, and amortization. Again, I'm looking at valuation here. I'm still on point number 2. And then I'm going to look at it from a standpoint of price to sales. And you can see this has been a powerful top line company. Alphabet has grown sales at almost just under 30% per annum going back to 2004. So clearly this is a very, very powerful company. Now, I don't have any dividends, but I do have, performance expectations here, rate of return. So, I'll go ahead and look at performance, historical performance. And what I discover is Google has averaged about 26.2% compound annual rate of return to shareholders that bought the stock, back in September of 2004. Okay. So I'm going from August of 2004 to yesterday's close. And a $10,000 investment would have grown to over 549, almost 550,000, significantly better than the overall market. So I've got good performance, but what about future? So, all I've done here is I've validated the fact that historical performance of the business has correlated with the historical results that shareholders go. So carrying that notion in forward and looking at forecasting graphs, the estimates for sales are sales to continue to grow at 20%. So the price to sales makes Alphabet look attractive, giving me double-digit return potential. Going back to the normal operating numbers, I'm going to use the normal multiple here of about 26 over the last 5 years. That's been the average multiple. Now, I can review how the market's been valuing the stock historically by looking at this drop down here, and I can see it's been as high as 28 times earnings and so on. I'm using a 26.7, which is the actual 5-year average here, or the 5-year normal PE ratio, as you can see I'm using here. And this means that the stock looks reasonably priced if it trades at that. But I do want you to note that I've got this surge of earnings, almost 85% expected for this year, which ends, of course, in a couple months. And then I've got very low expectations for growth for next year, and then followed by double-digit earnings growth again. So what I'm doing here is I'm looking at reasonable return expectations. Long-term growth is expected to be about 28%. Now, these are the analysts that are reporting to FactSet. And if it was able to grow at that, I could still have the potential to make double-digit rates of return, over 18% a year, if the stock traded at its PE growth rate, or 27.89 times earnings out here. If it traded, if it still stayed at that normal, 26.7, I could also then, look for that as close as I can get here. And it's going to be somewhere between 16 and 18%. These are just reasonable return expectations. Now, I'm looking at the analyst expectations here that are collected by the analysts reporting to FactSet. I can also go to other services like Yahoo, and I'm going to get very similar. I get $108.69 worth of earnings for this year and $111.87. On Fast Graphs, what we have is 108.30 and 111.89, virtually the same number. If I go into a service like Zacks, I also will get the current year 107.86, next year 114. So the point is, these are different analysts from different sources, Reuters, FactSet, and now Zacks, where Zacks collects their analysts, and their next 5-year number is 25.8. Google's next 5-year number is 21, and the Fast Graph, basing on FactSet consensus, is 27.8. Those are all corroborating estimates. Remember, these are estimates. You can't expect them to be perfect. You have to just consider, are they within a reasonable range? And all of these analysts are looking for the company to grow over the long term at over 20% a year for sure, and even up as high as 28% a year, which means this company looks very, very attractive, going forward. So I've got all of the bells and whistles or check, on the Fast Graph. I've got, all the earnings growth, the valuation, the reasonable return expectations. I've got the AA+ credit rating, so that's higher than investment grade. I don't have any dividends, so I'm not worried about free cash flow covering the dividends. And I do have, cash flow from operations growth or operating cash flow growth, also very, very strong historically. So Now I've decided this company, because of its powerful growth potential, is worth looking further into. So now I'm going to move on to the financial underlying numbers, and I'm going to look at cash flow from operations being higher than net income. So I've got net operating cash flow higher than net income. That's number 8 on my checklist that I presented earlier. It looks real good. I'm looking at sales and revenue growth. That'd be the gold line or the gold bars in this graph. I've got great growth over the last 3 to 5 years especially has been very, very strong, which I like to see the whole long-term picture here, but I'm really focused on the 3 to 5 years. Those are, the more recent, the better. Net income growth is a little bit lumpy relative to the other metrics. We did have a down year in 2017, but otherwise we've got a pretty perfect record, and the last 3 years have been very, very strong. So I'm very satisfied with net income. Now I'm going to start looking at some ratios. I'm going to look at the debt to equity ratio as 0.1. That's, very, very good. I'll look at that a little bit later in a different way for you also, just to put it into perspective. But I'm going to also then go in here and I'm going to look at gross and net profit margins. Okay, the company obviously generates gross margins, in the 50% range for the last several years, although that's been drifting down a little bit. But their net margins have actually been slightly improving into the 20% range. They were as low as 11 in 2017. So the company generates good margins. I'm going to look at things like asset turnover, assets to sales. So I'm going to go ahead and go into the company's balance sheet here, and I'm going to plot total assets. And then I'm going to go to the income statement and look at sales. And you can see that the company is, turning over their assets, pretty well relative to sales. This is assets divided by sales. I'm going to go back to the ratios graph. I'm going to look at things like return on invested capital. And as you can see, the return on invested capital here is very strong, averaging over 14%. I'm going to go ahead and look at return on assets and returns on equity as well. I'm just going to check some numbers. I'm looking for returns on assets of 10% or better. I got to check here. I've got return on assets of 13.5. I'm going to look at return on equity of 15% or better. I got return of equity, we'll call it 19%. And then I'm also going to look at the operating margin, which is EBIT divided by sales, earnings before interest and taxes, or operating margin. And you see I've got very, very strong operating margins. So that runs me through my 16 points, looking at Google. And, what I determined here is this is a very powerful growth stock. It has very powerful growth expectations going forward. I think the only caveat that I would like to put here is that, there could be some moderate weakness next year in terms of earnings growth. That may or may not, turn out to be the case, but it is something that I would watch for. Excuse me, I got the wrong metric here. Let me look at adjusted operating earnings are expected to be very weak at about 3.5 to 4% next year. That could be a drag on the stock temporarily, but if you're looking to own this stock for the long run, this is, really a powerful growth stock, and it's not necessarily crazy undervalued at this level, but I would say it's a reasonable value here. So that's looking at Google, or a.k.a. Alphabet, or a.k.a. Google, through the perspective of the fast graphs and financial underlying numbers. I do consider this a GARP, a growth at a reasonable price, but it's not growth at a cheap price. I want to make that clear. But because of the power of compounding, growth stocks like this can still generate good long-term returns. If it was me, I'd wait for a better price. I'd be patient and wait for a better price, but you could be building a position, and if it does drop, even add more. Growth stocks, because of how fast they grow their businesses, give you a lot of flexibility as an investor. Anyway, this has been Chuck Carmel saying thanks for watching. If you like this video, give me a like, ring the bell, give me a thumbs up, subscribe to the channel, and also take a look at subscribing to Fast Graphs, the fundamentals analyzer software tool. I wouldn't even think of investing in stocks without it. Thanks for watching.